0.7%. That right there is your opening bow. Joining us now on Bloomberg TV and on Bloomberg Radio, I'm pleased to say that we're joined by the Richmond Fed President Tom Barkin alongside the brilliant Bloomberg's Mike McKee. You happy with that introduction, Mike?
I like
that. Work for you? Good.
Yeah.
And the brilliant President
Barkin.
Tom, great to catch up. Thanks for being with us.
Yeah, thanks for having me here.
So we get some Fed speak 60 minutes after the inflation report. So let's start there. Your response to that CPI print we got a little bit earlier.
It's about as expected. Inflation is normalizing, but it's coming down slowly. And I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. Part of that is still COVID factors, excess money in people's pockets, supply chain issues in places like cabinets and switchgears. Part of it is business factors. There are businesses out there still trying to recover lost margin. But I think the biggest thing is that after the experience of the last couple of years, businesses have now understood that pricing is a lever again. And as I talk to the folks in my district, I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are.
So one thing we've heard from Fed officials, including the chairman, is that the disinflationary process has started. Is that something you agree with? Do you see much evidence of that? And where do you find that evidence?
Well, if you look at the 12-month numbers, you can see they peaked several months ago, and they're coming down steadily. But that's one part of the puzzle is inflation coming down. The other part is actually hitting our target. And so it's going to take a while to get to there.
Do the latest data that have come in, not just today's CPI, but the jobs report, et cetera, change your view of how far the Fed will have to go beyond perhaps what was in the SEP for December? And does it change your view of inflation dynamics?
Well, I try not to get too wound up in any particular data read, particularly a January data read, large seasonality factors, all that sort of stuff. But I do think what we're now in a position to do is to react to multiple months of data as they come in. We may or may not choose to take rates up further if inflation continues to persist, but we'll have to see what happens.
Well, based on what you're seeing right now in terms of the path of inflation, the dot plot said 5.13% in December. You think that's enough?
I think we'll see. We're going to get a PC at the end of the month, another CPI before the next meeting. And then I think as the meetings go on this year, we'll see what happens to inflation. If inflation settles, maybe we don't go quite as far. But if inflation persists at levels well above our target, maybe we'll have to do more.
Well, do you think that maybe you and the markets are on a different time frame? You're going meeting to meeting, and they're looking out towards the end of 2023, saying you should be cutting rates by then?
I'm not sure I understand markets. You guys are much better than I am. I'm very focused on what's happening in the demand in the economy. I'm very focused on what's happening to inflation. And I think the way to think about my view on rates is were inflation to persist, we might have to do more. If inflation doesn't persist, maybe not.
How do financial conditions factor into that call, into that view? How do you think about financial conditions?
Well, there's lots of definitions of financial conditions.
How would you define it?
I think that as we raise rates, the market and all markets, sort of respond to how we're doing things in the path that we forecast. There are people who are out there saying financial conditions are back where they were a year ago, and I say, I don't know. It looks like rates are higher than they are a year ago. Certainly if you're trying to get a mortgage, that's what you think. And so the financial markets make their forecasts and, lending conditions, whatever, work off of that. I think you can try to manage it, but I'm in the world of try to define your response function, try to live to your response function, and I think markets will catch up to what you're doing.
If we can dig a little bit deeper, we've had a decent equity market rally year today. Credit spreads are, I think, something like 200 basis points tighter than the wides of last year. Do you see that as complicating your ability to tighten financial conditions and bring inflation back towards target? Is it something that's on your mind a lot?
I think trying to manage markets, at least for me, is a fool's errand. And so I'm in the world of trying to manage what we can control. If demand stays hot, if inflation comes in elevated, have rates move more. There are lots of other scenarios of what happens in the economy, and we'll respond to those.
Well, one of the questions that people are asking is, does it make it harder? Does it is the market pushing back against you, and do you see inflation maybe stickier because of that? And is it a question of you have to raise rates higher or leave them in place longer and wait for the cumulative weight of tightening to hit?
Well, I think there's a very good case for leaving rates higher for a longer period of time to allow that tightening to hit. I do think the lesson of the 70s was very clear, which is don't give up too early. And anything I've read, and I've talked to lots of other people who seem to have understood that market, they say, you know, if you go back to the Arthur Burns years, it was raise rates, economy weakens, lower rates, inflation comes back stronger, raise rates, economy weakens more, lower rates. That doesn't seem like a path that makes a lot of sense to
Does
me.
history weigh on you when you refer back to the 70s? Do you really feel the weight of that?
I've done a lot of reading about it, and I think for better or for worse, we've got a really good episode where our predecessors did the right thing and got inflation back under control, and I think that's certainly an aspiration for me and for us.
You understand the view of market participants that when they hear things like the disinflationary process has started, they get the sense that we're moving away from that language, that we want to learn from the lessons of the 1970s, we want to be tighter for longer. They see that as new information. The first step, and you'll hate this word, the first step towards a so-called pivot. Why isn't it that?
Why isn't this a pivot?
The first step towards one. By acknowledging the disinflationary process has started, for some people, market participants that speak to us on a daily basis, they view that shift in language as a step away from the Chairman Powell address we got in Jackson Hole, Wyoming, which was 8 minutes, down the camera, super blunt, there's going to be pain, it's going to be painful, but if we don't do this, it's going to be even more painful. 4 or 5 months later, with an equity market rally in between and a bit of deceleration in inflation data, it's now the disinflationary process has started, and that's the focal point for so many people. Why isn't that the first step towards a pivot that says, okay, we can back away?
Shoot, I just try to keep it simple for myself, which is nobody really knows how inflation is going to play out over the next year, over the next 2 years. And so I think what I can do is talk about how I think about it. The way I think about it is if inflation stays elevated, if it persists, we'll have to do more.
Well, you struggle with what the markets are thinking, but you're probably very good on what companies are thinking because, of course, that's your background and you talk to CEOs all the time. What are companies thinking? You mentioned that some are still pushing the envelope on prices, but what's their outlook for growth and particularly employment and wages over the next 6 to 9 months?
So the way I put it is everybody's got a recession playbook. It's in the drawer. They've taken it out. They've dusted it off. They've updated it. Right? They have a very clear sense of if things were to turn south, what they do. For the most part, they haven't turned the pages of the playbook. And the reason they haven't turned the pages is that their business actually remains pretty sound. Now, that's not true if you're in mortgage lending. That's not true, obviously, recently in the tech world. But in most of the businesses I talk to, it's still not the point where they pull that. And part of it is they really fought hard for 18 months to get workers. And they're really reluctant to shed workers if it turns out that they didn't need to. And so I think there's still a reluctance. And when you see things like the recent jobs report or some of the consumer spending data we've seen for January, you start to see that in the business's actual demand set. And they're saying we're not there yet. But of course, we all know the world could turn and they could get there. I just don't think they're there yet.
Well, that brings up an important question about your reaction function when you're predicting that unemployment is going to rise significantly because you're trying to clamp down on demand, and it doesn't happen. How do you incorporate that into your thinking about where you are?
Well, I think we've taken rates to where we've taken them. We've signaled, or at least I've signaled, that if inflation persists, I'll continue to respond appropriately. You do know that there are long and variable lags with rates. And so you're watching the demand side, not because the objective is to manage demand, but because the objective is to manage inflation. And so you're looking for signals that inflation comes down. You're looking for signals that demand is weakening, softening in places where that would be relevant to inflation coming down, and you play it out.
Can you explain longer variable lags to us? Because some people have come on in the last 12 months and they've said to Mike, they've said to myself, to Lisa, to Tom on Bloomberg TV and radio and said, they're not that long at all, they're pretty short. Financial conditions will price it all in immediately, they'll tighten, and you'll feel it pretty quickly. Are they that long? Are they that variable?
You didn't like financial conditions a second ago, and so we'll work on that. I do think we've seen in a number of sectors, particularly interest-sensitive sectors, particularly sectors where the strength of the dollar matters, you've seen demand move very, very quickly. And well before we started increasing rates, mortgage rates increased, and that, of course, meant the lag in that sector was less than the world where we used to hide what we're doing.
Yep.
On the other hand, if you go in lots of other places, think healthcare for a second, a big part of the economy, it's not at all clear that the rate stuff we've done or are doing is having that much impact on demand. And I think that's where it takes more time. And the studies I've seen suggest that there's a period of time to go from raising rates to the impact on demand. But I think the real issue here is from impact on demand to impact on inflation. And that's really, when you talk about the long end variables to inflation, and then I get back to where I started. And I would just say, there's the sales department, the finance department. The finance department loves raising prices because it's the fastest way to move the bottom line. The sales department historically has been very nervous about doing it, either because of incentives or market share or whatever. After the experience of the last couple of years, the finance department has a lot more sway in that conversation than they used to.
So how would you characterize the balance of risk at the moment? With all of that in mind, and it's tremendously difficult to confront as a policymaker, Chairman Powell said repeatedly a few times last year that the risk of doing too little outweighed the risk of doing too much. Is that still the case?
It is for me. I mean, we're still in a 3.4% unemployment economy with inflation, depending on which measure you want to look at, well over our target, 6% on a 12-month basis. Feels to me like the risk is on the inflation side at this point rather than the economy side.
We are talking with Richmond Fed President Tom Barkin on Bloomberg Television and Radio. Thank you to all of our viewers and listeners around the world. What is your view in terms of the growth outlook at this point? It seems like we went through a phase of recession's inevitable, then we're going to have a soft landing. You have people saying no landing. Where do you come down on all of that?
I keep trying to look at past recessions or past economic tightening cycles and ask the question of which this is most like. And of course, the ones that are most recent in our memory are all recessions where something winged in from left field, whether that be 9/11 or the financial crisis or the pandemic. And so I think we may be looking at an economy more like the one that I remember back in the early 90s, where there was a tightening cycle and different sectors got hit one at a time. It seemed like much more of a rolling situation. And so the overall numbers perhaps aren't going to be as negative. Again, I'm assuming nothing comes in from left field, but aren't going to be as bad as the ones we remember from 2 years ago or 15 years ago. But we'll see.
Well, when you sit down on March 22nd with your new projections for the economy, are you marking up growth? Are you marking down growth? What do you think is going to happen?
I've got a month before I need to make those projections. And I'm teasing, but I'm quite serious about it. We have a real serious process. We run multiple models on this. We take in all the most recent data. We will get another jobs report, one perhaps with less seasonality impact. We'll get another PCE and a CPI. And so I wouldn't want to front run our team and our models on that forecast.
Just in terms of risks around the view already projected from December, upside risk for growth, for inflation, for the terminal rate, how are you thinking about things currently?
Well, the biggest surprise has been the jobs market. I mean, the jobs report we got a couple weeks ago was quite significant and much stronger than what I had anticipated. And so the question in my mind is going to be, are we going to get another one like that in February, or are we going to get something in February that revises, corrects, moves it down? So I think that's really the key thing I'm looking at in terms of growth.
It's been surprising for all of us to see unemployment come lower. There was a take, I think, last year. Mike, you and I talk about it all the time. This is the Fed's job. They need to get unemployment up to get inflation down. And it sounded ugly, it was brutal, it was difficult to communicate as a policymaker. Do you still see it that way? Do you need to get unemployment up to get inflation down?
I see we need to get inflation down to get inflation down. And what I mean by that is, our tools work on demand, they work on lots of various things, but the key to this whole thing is getting inflation down. I don't start with unemployment, I start with inflation. And we'll see what happens on the employment market. We're still at 3.4% unemployment. That's a historically low number. You're talking 1969 and before that, 1951. And so, there's been a lot of talk about the jobs market so far, quite strong. We'll see what happens.
Are people in the companies in the Richmond district telling you that they are still having trouble finding people, or has that eased?
It's not as desperate as it was a year ago or a year and a third ago, but it's still very tight. On the professionals, though, I think that has kind of loosened. Some of the layoff announcements recently have sort of hit home. People trying to hire tech workers are having an easier time doing it. For the frontline service workers, still very tight. But people are getting by, whether it's lower service levels or not cleaning the hotel room every day. The place that's still screaming tight is skilled trades. Construction, nurses, truck drivers. We just don't have as many as we need. Demand in a lot of those places remains elevated. And folks are really struggling to find those folks. That's really where it's the tightest.
Let me ask you about the balance sheet. It's been running in the background. It's been paint drying, but there have been concerns expressed in the short-term money markets, and we're still seeing a lot of money put back into the repo facility. Is it working the way you want it to? Are you getting the results that you want, or is this also a case where the markets are not reflecting necessarily what you're trying to accomplish with QT?
I think we did a bunch of actions we thought important at the time in terms of stimulus and supporting the markets back in 2020. We're now trying to unwind that. I think our primary tool is the rate tool. It's not the balance sheet tool. The objective is to unwind the balance sheet expansion that we did and do it in a way that doesn't change any focus on our primary tool, which is the rate tool. You guys still seem to be focused on the rate tool, so I think so far so good.
We're focused on the balance sheet too, so let's stay there. I'm sure you're pleased that people see it as paint drying, but it's not. It wasn't just an objective to get the balance sheet up. You were looking for a consequence from doing that. You said the objective was to get the balance sheet down. Are you not expecting there to be a consequence there?
I mean, first of all, the analysis of the impact of balance sheet movements is unbelievably difficult, arcane, opaque, and tortured. And so I've really struggled as I've kind of come into this to come to ground to it. Where I've landed is it's got to be symmetric. If you believe that adding to the balance sheet does something, then you got to believe that shrinking the balance sheet does something else. So I've got no question about that. I do believe that on both the expansion side and the reduction side, it's a lot smaller than some of the estimates you'll see. And people talk about the impact of buying more bonds. There's also a signaling effect when you're buying. I think the signaling effect may actually outweigh the impact of buying the bonds. The signaling effect in terms of when you would finally raise rates or whatever. When you're shrinking the balance sheet, there's a shrinkage effect, and then there's a signaling effect. The shrinking effect, of course, I would say is parallel to the expansion. And then the question is, what is the signaling? The signaling tends to be around liquidity. That's the conversation that gets raised. I just would come back and say, compare today's balance sheet to 2018 or 2019's balance sheet, it's still so much larger that I have trouble seeing that liquidity is actually being driven by what we're doing right now.
Back at home, what worries the people of the Richmond district? I mean, we have the idea of a possibility of recession. We've got what's going on with energy prices because we don't know what's happening in Ukraine. There's this whole idea of the debt limit leading to a default. How much are people in your area focused on those things?
What I hear over and over and over again is that people hate inflation. And that's what they're focused on. I mean, people hate inflation because it seems unfair. I mean, you get a raise and then you spend the money you just got at the gas pump. It feels arbitrarily taken away, creates uncertainty, and it's just exhausting. It's exhausting to shop around for better prices. It's exhausting to defend your prices to a customer, and so people are really excited about the prospect that we might get inflation under control, but you don't have to look much beyond the sentiment indices to see what people think about inflation, and that still is the overwhelming conversation we're having.
I have to ask you this. It appears that at the Federal Reserve, you're going to be in the market for a new vice chairman. Lael Brainard, what does she bring to the Fed and to the Open Market Committee? How would you characterize her tenure?
Well, I don't know what will or won't happen from the administration, but Lael's an asset. I mean, she's very smart, she's very capable, and she's an asset to us, and if she does something else, I'm sure she'll be an asset there.
She's been seen as one of the doves on the board. Is there such a thing, and was she?
We have 19 really, really capable people on the committee, and I listen to every one of them because every one of them brings a unique view. And as we've learned in the last few years, people's views change as the data comes in. And so, I've got colleagues that you might think are doves who might go the other. I mean, I think so. It's. I think people take the job very seriously, and they're very genuinely interested in landing the plane on whatever is actually the situation in the moment, as opposed to, I'll call it, a pre-existing leaning.
There's rarely any dissent. Why is that?
You mean dissents or dissent singular? Because I had the privilege of sitting in the meeting, and there's lots of points of view that are phrased. So I wouldn't be confused about the idea that there aren't a lot of different points of view raised.
Give us a bit more clarity on that, because from the outside looking in, sometimes it feels like groupthink. There aren't people that come out that say, I disagree with the decision and this is why. It's incredibly rare, particularly from the board. How much of that is actually taking place inside the building around these decisions that we're just not aware of? Why isn't this groupthink?
Well, I spend my time every 6 weeks, 7 weeks per meetings. I go into the market. I don't spend a lot of time in my building. I'm trying to figure out as best I can what's happening in the economy from people who are participating in it. I try to come up with my own points of view in terms of what's happening to economic conditions and where we ought to go with policy. And I show up with my points of view. And then every time I go there, I learn something. And I learn from people who are doing the exact same thing with their own independent views. I think the structure of the system is very well set up to gather independent views. And then, of course, the meetings are very well led in an effort to put those on the table and try to land on a place where, you can get some version of a consensus.
One of the things people have been critical of is that there are 19 members of the Open Market Committee who are speaking all the time, and it can be confusing to markets and to the public. Do you see that as a valid critique?
Well, I'm privileged to be here, so I guess if I say no, then I'm asking
You're the only one that's
I'm
allowed
here.
to come back regularly every day.
No more interviews after that.
Exactly. I see a huge part of my job as trying to translate what we do into the district that I serve. And so, like I said, I really am on the ground all the time. I'm doing chambers of commerces in small cities. And I think there's a real thirst for understanding. And I think there's real value to the people in our community hearing from and understanding people who they think are actually rational, not, people from Washington, if I could put it that way. And so I think there's huge value in that. You guys choose to cover it. I'll leave it to you whether that's the right thing to do or not. But I don't see it as getting on. I see it as actually talking to the constituents in my district.
Just one final question, and you've been incredibly gracious with your time, so thank you for that, Tom. It's the third year of pandemic economics. China's reopening. I feel like the consensus has been dead wrong every single year on every major issue. As we go into the third year of all of this, how are you thinking about that challenge as a policymaker? Is there something you're hesitant on drawing too many conclusions on too prematurely?
Right. I think we're normalizing, but you can't ignore the impact of the pandemic, that the pandemic is still having in the economy. Some of the things we've talked about, businesses reluctant to shed workers because of the history, shortages in switchgears and cabinets, $1 trillion plus in excess savings still out there, the infrastructure bill still being deployed. All of these things are, if I could call it, not normal, artificial things that are in the economy today that weren't in the economy 3 years ago. Now, for me or for us, you have to take it as a given. And so you try to make policy against the economy you've got, not the economy you wish you had. But I think for sure you've still got that in the economy.
President Barkin, thank you. You can do as much Fed speak as you like, just so long as it's like,
right here. Yeah.
We're Mike McKeon.
We're open every day.
I appreciate the time. Thanks for having me here.
Thank you. That was Thomas Barkin, the Richmond Fed president. Coming up, the market movement events you need to be watching. We'll get to the trading diary in just a moment. Live from New York, this is Bloomberg.
trying to manage markets, at least for me, is a fool's errand. And so I'm in the world of trying to manage what we can control. If demand stays hot, if inflation comes in elevated, have rates move more. The biggest surprise has been the jobs market. I mean, the jobs report we got a couple weeks ago was quite significant and much stronger than what I had anticipated. And so the question in my mind is going to be, are we going to get another one like that in February, or are we going to get something in February that revises, corrects, moves it down? So I think that's really the key thing I'm looking at in terms of growth.
Fantastic to catch up with the Richmond Fed President Thomas Barkin there alongside Mike McKee as well. Just a little bit of response there to the CPI report we had about an hour and 25 minutes ago. Not much of a market response, very jumpy in the minutes afterwards. Right now totally unchanged on the S&P 500. On the Nasdaq positive 0.2%, trying to build on the gains of yesterday's session to start the week. That's the equity story. Here's the bond market. Yields higher, particularly at the front end by 6 or 7 basis points. Very close to 460 at 458 on a 2-year. Yields up 6 basis points, new highs for the year there. That's the price action. Let's get you the trading diary. Coming up, Fed Speak continues. Logan, Harker, Williams all on deck. President Biden discusses the economy 1:15 Eastern time. Retail sales tomorrow. Big data point for us to cover together. Jobless claims on Thursday. And finally, some more Fed Speak through the week. Mester, Bullard, Cook, Barkin, Bowman to close out the week. From New York, that is it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, February 14th. Here are the top market stories we're following for you at this hour. Starting off hot, inflation 2023 comes in higher than expected, with housing closing couches leading the increase. We try to find out if disinflation is fact or fiction. And high yields rattle markets. Your bonds selling off, yield spike. Equity's pretty jumpy. Richmond Fed President Tom Barkin says higher rates for longer. And CEOs tilt a bit dovish. Goldman's David Solomon says CEOs see a chance of navigating to a softer landing. We're going to get the view from the C-suite with Compass and Marriott's CEO. From New York, I'm Alex Steele with my co-host in London, Guy. No, Guy's not there. It's Danny. Autopilot is a real thing. Guy's on vacation. Danny is with me here. Welcome everyone to Bloomberg Markets. Danny, always a pleasure. I don't think that you're Guy. I have to say, trying to take some kind of signal from the market action, particularly in the equity market after the CPI number, is a little troubling. I truly can't get a good takeaway here.
Even the FX market, there was a moment, and I mean a moment, literally minutes ago, Alex, where the dollar was stronger, and I was ready to say, okay, bond market, dollar saying the same thing, considering front end rates are higher, the curve is more inverted, but now we've lost Team Greenback. So everything is confused except perhaps for this bond market, with swaps now pricing out a full cut for this year.
Yeah, and I also want to point out too that I wonder if how much of this is to positioning. So that's where I think the fund manager survey from Bank of America is really interesting. Basically saying that only 31% of investors are now underweight. So positioning is light. So you may not get the big market swings, and you're also seeing a lot of overweights in the bond market, which may mean that they're more sensitive to some kind of sell-off and then higher yields.
Right, and I'm just looking down at what this equity market is doing, Alex, and NASDAQ up 0.5%, S&P up 0.2%. So positioning is light, but I also wonder if it's also that Pavlovian urge to buy that, yes, the numbers came in line, so perhaps you can use it to fit your narrative. And to that point, Alex, as we've been discussing, those CPI numbers really showing that elevation, elevated, it is staying put, and it puts more pressure on the Fed. Richmond Fed President Tom Barkin spoke earlier to Bloomberg's Michael McKee about this morning's data.
Inflation is normalizing, but it's coming down slowly. And I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. Part of that is still COVID factors, excess money in people's pockets, supply chain issues in places like cabinets and switchgears. Part of it is business factors. There are businesses out there still trying to recover lost margin.
All of this gets us to our question of the day: disinflation, fact or fiction? Joining us now are Bloomberg's Michael McKee and Katie Greifeld. Mike, let me start with you. The data, we had been looking for a confirmed trend of disinflation. Did it confirm it, or did it throw that out of the picture?
It doesn't throw it out of the picture. It's a little more confused after this month, although there are some technical reasons why we saw inflation come in a little bit hotter, and then there's some actual price increases that affected the CPI numbers. But when you look at the overall numbers, it is performing as it has been and sort of as expected, in that goods prices are going down. They're not going down, but they're rising at a much lower rate. And services prices are still increasing. Now, the number that everybody wants to see, because Jay Powell highlighted it, is services ex housing, and that did come down. And housing does play a big role in the overall inflation numbers, particularly in the core. It's about 40%. So once you take that out, you see what's really happening with inflation, and it is going down. So the disinflation process is underway. It's just going to be lumpier, and as Tom Barkin said, stickier, take longer to play out than perhaps folks in the markets would like.
Right, lumpy and bumpy. I would feel like usually stocks wouldn't like that, which then leads us to the market reaction, Katie, which is, like I was saying, a bit confusing.
It is confusing. I mean, if you look at the bond market, to the question of the day, it seems to be saying that disinflation is fiction, but then you look at what tech stocks in particular are doing, doesn't make a lot of sense. The only thing that does make a little bit of sense is that this is a disconnect that we've been watching develop over the past 2 weeks, where you have the bond market really coming in line with what the Fed is saying. That hawkish messaging that we've been getting from speakers feels like the bond market is listening. The stock market isn't quite there yet, still pricing in this sort of immaculate disinflation. So which narrative you believe, I'm not really sure, but it's going to be interesting to hear from Fed speakers such as Barkin that we heard from just a little while ago, how they digest this data.
Katie, I really love that in your story you wrote, you were speaking with Art Hogan before this, who said that the CPI data, it's going to be a test of who's right, is it the bond market or the stock market? I guess this wasn't the test because, as you say, the disconnect still is there. So what does it take then to shake equity investors, to wake them up for it and the bond market to get on the same page?
It's a great question. I mean, if you think about what the next few weeks will look like, it feels like we're in a little bit of a data desert here. We have PCE coming up at the end of the month, and we have next month's payrolls print, but it might come in earnings. Obviously, we've been very focused on the macro, but we are in the heart of earnings season. It's been worse than expected, and still you've seen this really robust rally to start 2023. But maybe if you combine the two, the fact that we do have inflation that seems to be slowing down, that disinflation, and we also have a less great earnings environment, maybe that's what finally starts to shake the stock market. But it is incredible how resilient equities have been.
Hey, Mike, after talking to Barkin for half an hour, did you learn anything new about how the Fed's looking at a potential disinflation? And you guys talked to him about, like, why are you using this all the time?
I think that the general view hasn't changed, that it's going to be less that they have to raise rates more unless we get some more disappointing numbers, but the rate increases they promised us are going to come, and then it's all about leaving them in place and letting the accumulated tightening have an effect on the economy. And that's going to be the issue, I think, that the market will struggle to understand a little bit once we get into that phase, because you're looking for results without seeing a push for those results. It'll be what's built up to this point. The question is, do we see the sequential changes in inflation? Barkin thinks we will, but it will take time and it will be lumpy. And I think that's the general view overall on the Fed at this point. I don't think today's number is going to change a lot of their views in that regard.
And I know you asked Barkin about this as well, Mike, but of course Brainard now moving over to the Biden administration. Does that change anything for the Fed?
Not really. I mean, it makes it more difficult for them because she was a very useful vice chair who was in charge of a lot of the committees that they run there in terms of running the business of the Fed. And she was a somewhat influential voice, seen as a bit of a dove, and I don't think that means the same thing it used to mean. More like she's looking at both sides of the issue and saying, what about moving more slowly? So that'll be a loss, but they they will still have 6 members on the committee, and that will be on the board rather, and that will be enough. And the question then is, do they get a replacement, and if so, who is that, and what will they bring to the board?
Going back to the disinflation convo, Katie, the idea was that stocks were front-running the disinflation trend, right? Then we get the number, and we actually get it coming in a bit hotter than expected, and yet you still have stocks rally. Are stocks no longer front-running the disinflation trend? Are they actually moving on something else, or do you feel like it's a positioning thing? Because I was also looking at the fund manager survey also and see like how much lack of enthusiasm there is for, say, tech.
It could be a positioning thing that you have seen positioning be a little bit light. I mean, what I like to look at is ETF flows, kind of my thing. If you look at her book, she's talking her book. If you look at where the money's been going, it's been going into the Qs. It's been going into these tech stocks. I mean, QQQ saw, what, $2 billion come into it last week. You look at where the money is coming out of, it's actually the bond market. You saw HYG, that is the biggest junk bond ETF. It lost about $3 billion last week. That is the biggest weekly outflow since, I don't know, October 2020. So you add that together, it just seems to speak to investors maybe taking a little bit more risk in equities, being more comfortable with that for whatever reason. But when it comes to the bond market, when it comes to the credit market, they seem to be cooling there a little bit.
Yeah.
And then what about sort of this idea that the January rally could be undone, Katie, if all of that was just really short covering? Does that seem to have any credence? The fact that stocks, here we are in February, are still finding a bid, maybe complicating that?
Well, that's the thing. I mean, the January effect, it's very well documented that the previous year's losers become the winners. That textbook was what happened in January. But here we are on February 14th. Happy Valentine's Day. We're still rallying. So it gets back to your question, Danny, about what will shake stocks at this point. Again, you've seen some jitters in the bond markets, not just in treasuries, but in the credit markets as well. And you still have the equity markets resilient. How that comes back into alignment alignment, whether the bond market gets on board with stocks or the other way around. That's going to be the question going forward.
All right, so I think the answer is disinflation's fact, but like how we get there and like what it means for markets, we have no idea. Okay, guys, thanks a lot. Mike and Katie, I feel like I summed that up. Joining us, we really appreciate it. Happy Valentine's Day. You two are really nice and matching. All right, coming up, we're going to get more on the question of the day. Disinflation fact or fiction. Dominique Dvorak-Freco is a MacroHive senior strategist. They have a pretty aggressive call on where the Fed funds rate could get to. We'll discuss. This is Bloomberg.
I think the most likely scenario, and I give it 50%, is that we end up with sticky inflation, 3 to 4%. There is a possibility of an orderly disinflation. I give that 25%, and there is an equal probability of 25% of a U inflation, that we find out that service inflation is very difficult to bring down.
If you look at the 12-month numbers, you can see they peaked several months ago, and they're coming down steadily. But that's one part of the puzzle, is inflation coming down. The other part is actually hitting our target. And so it's going to take a while to get to there.
That was Richmond Fed President Tom Barkin in an exclusive interview at Bloomberg TV interview earlier today. Want to get back to the question of the day: disinflation, fact or fiction? Let's get the take from Dominique Dvorak-Freco, a MacroHive senior strategist, joins us now. Dominique, fact or fiction? What do you think?
Sadly, fiction. I mean, just look at the breakdown of the data. Goods price, core goods prices that were falling, actually stabilizing, and despite strong trends of deflation in used car prices. So I think the gains from the improvement in global supply chains are over, and price stabilizing. Look at shelter price inflation. You know, where is that disinflation that we've been promised on housing? Look at property prices, they are stabilizing. Look at the Zillow rental index, it's stabilizing. Show me the disinflation there. And then, you know, core services excluding housing, when you have unemployment at the lowest level in 50 years, wages can only rise. The reason we have seen a slowdown in wage growth is because the labor market is normalizing, so overtime use is going down. People who are not forced to work full-time are now working part-time. All these are great news for the economy, but bad news for disinflation.
I wonder then, clearly we're going to be in this uncomfortable place for longer, Dominique, but how long? Is there a possibility that trend inflation just sticks around 4%?
I think it's probably going to go up rather than sticks around. If we have a reversal in energy prices, when unemployment is the lowest in 50 years, we are off to the races. What's brought the disinflation is a decline in energy prices, because we are in a high inflation regime where everything is correlated with everything else. And when that happens, core and energy inflation become correlated, as we saw in the 70s and 80s, and as we saw since the pandemic. And so if we have a reversal of this energy deflation, we are going to see core move up again.
Dominique, I mentioned earlier your terminal rate call is very high. It's about 8% for the Fed. And I'm wondering, how do we get there then with this scenario? Like, do they just keep hiking now, or do they stop because they see disinflation, but then they have to catch up later? How does this scenario play out? Because it looks much less insane than it did like 8 months ago when we were at 2 and you were like 8%. I mean, we're going to be at 5 very soon.
So first of all, the 8% is not something I plucked out of thin air. If you look at every Fed tightening cycle since the 1960s, it starts when the gap between the Taylor rule and the actual Fed funds rate is big, and it ends when the gap narrows or is zero. And right now, my Taylor rule Fed funds estimate is around 8%. Maybe, we'll end up around 7 rather than 8, but much higher than we are. So my scenario is that, for starters, in March, the Fed adds one or two hikes to the terminal Fed funds rates. Then mid-year, we have a recovery in energy prices because China is coming back on stream. That triggers a recovery in core inflation. The Fed is behind the curve and tries to catch up, and towards end year, maybe in the December SCP, that's where we see the terminal Fed funds in a 7 to 8% range.
Dominique, a lot of digital ink has been spilled about the fact that financial conditions have been loosening. Probably doesn't help as we're looking at now equities are rallying. I was talking to someone who said that Powell has essentially miscommunicated, made a policy error by giving up on trying to control this market, on trying to jawbone. What do you make of it?
So I totally disagree with that. I think what Chair Powell has realized is something, by the way, which has been a topic of internal discussion at the Fed for years. What he's realized is that jawboning the market is a losing proposition, because if you jawbone, you have to convey a much greater sense of certainty than you really have about the economy. So you start making predictions about where the economy and therefore where the Fed is going. The market thinks these are promises, it's positions accordingly, then you have to react and again, and all you end up doing is create unnecessary market volatility. I think that's what Chair Powell has realized. That's why he's no longer trying to jawbone, but for sure, I mean, I'm really feeling confident about this. He is watching financial conditions very closely.
Okay. Dominique, I'm afraid that's all we have time for. So great to speak with you this morning. We've got our first vote for fiction. That's Dominique Devoer-Foucault, Macro Hive Senior Strategist. Still ahead, Tesla workers in the state of New York launch a campaign to unionize. We're going to have details next on The Startup. This is Bloomberg.
Jobs Day, like Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Ford Motors is laying off about 11% of its workforce in Europe. It's the latest sign of industrial disruption caused by the automotive sector's shift to electric vehicles. Some 3,800 jobs will be cut, most of them in Germany and the UK. The car maker has reduced ranks in the region by 35% in the last 5 years. Coca-Cola reported fourth quarter organic revenue growth that exceeded expectations as consumers continued to absorb higher prices for the company's sweet sodas, fruit juices and energy drinks. Organic revenue, which excludes the impact of currency shifts and acquisitions, increased by 15% in the quarter. And the supply of batteries to Volkswagen and BMW could reap billions from President Biden's electric vehicle bill. Northvolt AB joined a group of European companies putting policymakers on notice about the allure of U.S. green tech incentives in Biden's Inflation Reduction Act. The tax credits included in the law cover about 30% of cell manufacturers' operating costs. If the Swedish startup builds a similar-sized factory in North America, it would save about $8 billion in tax credits by the end of the decade. And that is your latest business flash. Alex?
All right, thanks so much, Ritika. Yeah, Europe's definitely not going to be happy about that one. All right, 20 past the hour on the West Coast. Beautiful sunrise this morning. And let's get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Bloomberg technology co-anchor Ed Ludlow joins us now. Ed, I know it's an East Coast thing, but Tesla and unions, like how are you guys looking at that over there?
It's an East Coast story in this instance, but it's not a news story for Tesla, right, which is just over the water from where I'm sitting in terms of its Fremont facility. In New York, in Buffalo, there is a unionization effort underway this Tuesday. They will be autopilot data labelers handing out leaflets to their colleagues at the Buffalo facility which read, "Roses are red, violets are blue, unionization starts with you." So, you know, whether it gains traction or not, the key point is this is a specific group, right? These are people that manually annotate the video footage generated from Tesla cars to help improve the algorithms that power the autopilot and later the full self-driving system. I think we've got a terminal chart which shows Tesla's global headcount, right? So this is 800 potential individuals. Tesla had 128,000 employees globally as of its latest 10K at the end of last year. So it's a small effort, and the track record of union efforts at Tesla is not great. But the affiliate of the Service Employees International Union is also looking at the 1,000 other employees that actually do manufacturing in Buffalo. So it could be something.
So looking at that track record, that unionization effort track record, what can this current upswell learn in Buffalo from what's happened in the past?
That they face long odds. You know, in 2017, the United Auto Workers Union tried to unionize Fremont over the water from me, which at that time was the kind of only operational EV facility. The United Steels Worker Union tried in 2018. Even March of last year, Musk tweeted inviting staff to try and unionize, to have a union vote. And the inference that we drew from what he had to say was like, pay is so good and so competitive amongst staff that they won't vote in favor of it. You know, Tesla has a history as well of giving stock compensation to a broad range of workers, paying well, paying competitively. But in this instance in New York, right, that's what they're pushing for, the basics of better pay. You know, what these individuals who are annotating the data are saying is like, we're held to account for the time that we're at our keyboards, tracked and monitored, and we want that to go away. So it's an interesting effort because the world's different now, right, guys? You've seen the reports, the success Starbucks has had, but also tech names, Apple, Amazon, where unionization efforts have been more successful in the last few months in the last year.
Hey, Ed, does Elon Musk care?
I don't know that Elon Musk cares. I can't answer that question. All I do is, again, point you back to March 2022 and him almost calling their bluff and saying, well, go for it. If you want to try, go for it. Have the vote. But, you know, again, the consensus at that time was that he was pretty confident that no group of Tesla workers would vote in favor of it. And ultimately, they did not. And we still don't see unionization within a Tesla facility after many attempts.
And who of us can really know what is going on inside Elon Musk's head?
Thank you,
Ed,
saved
thank
me.
you
Yeah.
so much. You did a great job answering that question, though. Bloomberg's Ed Ludlow there. Thank you so much for joining us. Now, coming up after that CPI report with that really sticky inflation, we're going to talk about housing. It was half of the makeup of the game. This is Bloomberg.
We're about an hour into the U.S. trading session. Stocks very jumpy. The one thing we do know, it feels like stocks and bonds are kind of moving in their own way. They're moving to their own different tune here. Abigail's tracking the moves. Abby?
And here's the stock tune. Pretty wild indeed, Alex. Take a look at the NASDAQ 100. Pretty much flat going into that CPI report for the month of January, and then jumping higher, then sharply lower, down more than 1%, and right now up about 0.5%. So all over the map, but we do have stocks higher for a third day in a row. The S&P 500 up for a third day in a row, also reversing its loss. All of its highs at this point, but over the last 3 days, up more than 1.5%. There's that NASDAQ 100 again. Take a look at the stocks, really jumping in a big way, up 1.5%. Global Foundries put up a great quarter. That's certainly one influence. Plus, they mentioned that a lot of their customers and other chip companies not really seeing signs of a slowdown. That could be one reason why we have that two-year yield popping higher, up 7 basis points, 460. The idea that the Fed has more work to do. In fact, that was probably one of the messages of the CPI report. When you combine it with the jobs report, what we're looking at on bottom is the January jobs report coming in above 500,000 jobs added. The estimate down there, 189. What a blowout. And then here's that CPI for the month of January coming in up 6.4%, the estimate of 6.2%. At this point, it seems as though most folks are saying that it's somewhat in line. Lots of different reads on it initially. But again, stocks sort of handling it at this point. Yields higher, again, suggesting that maybe the Fed does have more work ahead. And then finally, let's take a look at some of the movers on the day, because we do have Tesla up nearly 3.6%. We have NVIDIA up 3.9%. So some nice gainers for these stocks, despite the fact that we have yields higher. Typically, their valuation, the higher valuation stocks would be down. And then to the downside, though, here we do have Apple and Alphabet down 1%. Alphabet, of course, last week had been down sharply on the AI fiasco. Well, it seems as that loss is continuing.
All right, Abigail, thanks a lot. Great stuff. Really appreciate Abigail Doolittle joining us. So let's go to the inflation numbers. Remain elevated in January. We know that. One of the biggest drivers, though, is housing. Well, joining us now for his take is Robert Refkin, Compass CEO. Compass is a real estate brokerage company that leverages technology to facilitate searches and sales. So good to talk to you. I want to talk to you for such a long time, Robert. Thank you for joining. What did you make of the numbers today? What does that tell us about the state of housing in the U.S. when you see prices rising, even though mortgage rates are still really high?
Yeah, in today's consumer price index print, shelter was the biggest, most dominant contributor. And that's consistent with what we're seeing across the larger real estate industry. In Q4, prices were actually up 4% year over year, and buyers were expecting them to be down much further. What we're seeing right now, we have a very unique perspective with 30,000 agents and 18% of the top 1,000 agents in the country at Compass. We're seeing that there's an early spring market surge. Buyers are back, more open house traffic, and multiple offers.
Is it, okay, so is it a buyer or seller market then now?
Yeah, it's, I think it's a more balanced.
Depending on where you are.
Exactly. It's a more balanced market, but there are more buyers than there are sellers. If I were to guess what will happen to price over the course of the year, I think there's more risk that prices go up than they go down, just because of the amazing amount of buyer demand that we're seeing right now.
So, Robert, Danny here in London, great to speak with you today. Thinking about these inflation numbers that come in, when you have rent topping them all, there might be this argument of, okay, the Fed needs to hike, make mortgages higher as well. But what actually is the relationship between higher mortgages and rent? Does higher mortgages necessarily mean that rents come down?
Yeah, so we went from all-time low mortgage rates last January of 2.65% to 20-year high mortgage rates in less than 9 months. And what that did is it moved a lot of buyers into the rental market. This past January in New York, for example, we saw record high rents of $4,100 a month. Now that is actually bringing people back to the buyer market. And so we're seeing the rents now contributing to the sale market at this time.
If we wind up seeing continued hiking from the Fed at this point, do you think it disrupts the housing market again, or have we moved, like, what do you think?
Yeah, look, as long as mortgage rates stay in the sixes, there will be more buyers than there will be sellers.
So 7 is just bad.
7s was bad.
Okay.
But 6, when you look over the last 30 years, 6 is still very reasonable. You know, I talked to a lot of real estate agents that say, I bought a home when it was in the high teens. I've met one agent who said, I bought a home with a mortgage rate of 20%. Right? And so 6.5% isn't that bad when you look at over history. And it's the new normal. Buyers are accepting these mortgage rates.
Are you seeing more buyers struggling with affordability right now, given these prices?
Yeah, affordability is definitely an issue for our country, but the lack of inventory is what's driving price. If there was more inventory in the market, we would see prices decline, but there isn't. And prices, we had 42% of sellers give seller concessions in December. That was the highest amount of seller concessions in 10 years. So the sellers, you know, they're feeling the pain, and you know, those concessions are bringing buyers back to the market. And those buyers coming back to the market are bringing prices back up.
Okay, so what does it mean for Compass in particular? You guys did 2 rounds of layoffs last year, right? September and June. Are you done?
We are done with layoffs, particularly with the momentum that we've seen in the market recently. We brought our expense target rate down to $850 million to $950 million. The market, as we're seeing right now, it will come back up, but what will not come back in any meaningful way are our expenses. And the delta will be EBITDA that we'll share with our investors.
Okay, to that exact point, opposite question. We're seeing a lot of tech layoffs happening, and you can make an argument that you guys are also a tech company, like half real estate, half tech. I mean, that's your pitch. Are you going to be hiring the people that are getting laid off?
Yeah, we're a technology-powered real estate brokerage. We're using technology to empower our real estate agents, nearly 30,000 people, to better serve their buyers and sellers. Like a lot of technology companies, we saw demand over the next 2 to 3 years be very, very strong, but the Fed came in and artificially reduced the revenue of our industry. And so we had to bring down our expense base accordingly. We are not focused on opportunistically hiring right now. We're focused on keeping our expense base low and simultaneously best serving our agents who are our clients.
So in terms of taking a step back again, Robert, to this wider market, I have to say opinions do seem to vary pretty widely on where the housing market goes from here. Goldman Sachs, they still see prices falling 6% from the peak. They did see 10% before. Do you think prices will fall this year, or could they even move higher?
Yeah, I believe that the range is somewhere between low single-digit decline and an improvement of low single digits as well. A lot of the research analysts that made estimates over the last month, it was based off of data that's old, right? The last 3 to 4 weeks have been a complete change in the real estate market. The open house traffic in New York City alone was up 42% this past weekend. The multiple offers are back in virtually every market, and we have more buyers than sellers. And so I think a lot of that information around price that we've seen for over the last few weeks is old data.
I'm curious as to what's driving that. That may seem like a really simple question, but I thought that a lot of young kids were living with their parents because they couldn't afford to buy new houses, and I thought that the rush out of cities into suburbs already happened. Like, what's this catalyst now?
So this time last year, there was an enormous amount of buyer demand. And it would have continued, but the Fed put an artificial wall in front of buyers by bringing mortgage rates down from 2.65% to 7.4% in just 9 months. And in the fall, it went from 5% to 7.4% in 2 months. It had never mortgage rates have never increased that fast. So it put this artificial wall in front of buyers. With mortgage rates going down from 7.4 to 6, the floodgates are opening. That's really what's happening. And all the talk of severe recession that we had in the fall is now more talk about a light, a soft landing.
But given the floodgates opened, it's not something the Fed wants to see. They don't want to see the housing component being moved higher in CPI. To some degree, Robert, you just brace, okay, mortgage rates are going to go up again. The Fed's going to move again. They want to stop this phenomenon specifically.
Yeah, my hope is that prices do not go up again in a meaningful way, because I don't want this whole thing to happen again. That was a very difficult year. But I don't think prices can go through the roof. Last year, remember, there were months where it was up 16% year over year. Q4 being up 4% year over year, that's a pretty positive. In November, prices were down from the May 2022 peak. They were down 2.5%. And so let's just say they stay at that May level all the way back until May. That means this next May in 2023, it would be down 2.5%. And so I think as we get through the next few months, we'll see a real tailwind on price inflation going down.
We have a question from a viewer talking about home values soaring over the last 5 years. We know this, but how come commission rates are still the same as about 6%? Do you expect them to come down as other industries have had to cut their kind of commission rates?
Yeah, so real estate agents set the commission rates. There are 2 million agents in the country. It's the largest group of entrepreneurs in the country. And my mom is a real estate agent, has been nearly the majority of my life. And they set the terms of their service with their clients. Everyone is negotiable, but they don't get paid salary. They only get paid for their success that they create for their clients. And in that conversation, the market is set where buyers and sellers want to pay for the best service.
That's a no. I think the higher commission rates are going to stay. Hey, Robert, so great to catch up with you. Robert Reffkin, Compass CEO, thank you so much. Coming up, business travel is improving. Vacationers are willing to pay more for hotel rooms. Can that all last? Marriott shares up after releasing results. We're going to speak to the CEO next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Secretary of State Antony Blinken is considering a meeting with China's top diplomat at the Munich Security Conference later this week. It would be the first face-to-face talks since a Chinese balloon led to a new spike in tensions. Blinken called off his trip to Beijing. They had been set for last week after the U.S. identified an alleged Chinese spy balloon hovering over U.S. airspace. A day after the trip was cancelled, the Pentagon shot down the balloon off South Carolina. Nikki Haley, a former South Carolina governor and Donald Trump's ambassador to the United Nations, is running for president.
Republicans have lost the popular vote in 7 out of the last 8 presidential elections. That has to change. When you kick back, it hurts them more if you're wearing heels. I'm Nikki Haley, and I'm running for president.
Haley is the first of multiple Republicans expected to make White House bids, including Florida Governor Ron DeSantis, after Trump announced he was running again nearly 3 months ago. Former Vice President Mike Pence is planning to challenge a grand jury subpoena from the special counsel investigating Donald Trump and his allies on grounds that separation of powers under the U.S. Constitution shields him from some Justice Department inquiries. Pence will resist the subpoena under the argument he was acting president of the Senate during the January 6th, 2021 insurrection. Global News powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, Ritika, thank you very much. To the market, Marriott International shares are up after results beat estimates. I should point out, though, that now we're seeing stocks kind of slide. S&P is down 0.6. Go figure. Well, Marriott says it sees business travelers paying rates that were 3% higher than in 2019. Joining us now is Marriott International CEO Tony Capuano. Hey, Tony, great to catch up with you. Super solid quarter. Your outlook looks really strong as well. What's going to be your growth driver this year? Let's start there.
Well, the great news, and you heard it on the call, we're seeing recovery in every segment. So maybe not surprisingly, leisure continues to be exceedingly strong. Leisure demand globally was up about 7% in the fourth quarter. Business transient, we're about 90% recovered. And for small and medium-sized businesses, we were actually 6% ahead of where we were in 2019. And maybe the most pleasant surprise was the strength of the group segment, which was not only up 10% in the quarter, but when we look into 23, our forward bookings are up about 20%. So we expect to see continued resilience and recovery across all of our most important demand segments.
The fact that you have pricing power with business travelers, I got to say, Tony, it does seem to fly in the face of other things we've seen from corporates who are right now just on this massive cutting spree, at least for businesses like banks and like tech. So what are the trends you are seeing there? Is the strength only coming from some industries, for example?
Well, it varies by size of company and by industry, to be sure. But what's encouraging to me, remember, during the depths of the pandemic, we actually rolled over our negotiated special corporate rates for 2 years. And so coming into 23, as we looked at the pace of recovery of business travel, we actually renegotiated those rates, and we were able to achieve close to double-digit increases in those rates. Certainly the small and medium-sized businesses have recovered more quickly. We are not where we want to be with larger employers, but their recovery has been consistent, albeit slower than we might like.
So that's interesting because basically you just told me that you're raising your rates for your corporate customers and they're still traveling. That feels inflationary to me. Where are people going the most, and kind of what pushback are you seeing?
So, I mean, you say inflationary. Certainly one of the great things about our business model, we have the opportunity to reprice our inventory each and every day. And so our pricing is very much moving in lockstep with the demand patterns we see. In terms of the second part of your question around geography, leisure destinations continue to be very strong. City centers that are appealing across all 3 segments are strong. And maybe those city center markets that rely almost exclusively on business travel have been the slowest to recover.
Given that we're now in this environment where the world has opened up, COVID's still here, but not in the same way it was, you have the revenge tourism coming back. But I wonder, Tony, if what customers want from Marriott has changed at all, if what they're expecting from the hotel experience has changed, and how you've accommodated that.
So a few things. One, all customers are not created equal. There are some with relatively short memories that want everything to be exactly the way it was pre-pandemic. There are others that are still understandably cautious, and so maybe they want a little less interaction and they want to lean more heavily on our technology platforms. But what I will tell you is they crave travel. They want to go see new destinations. They want us to continue to evolve our business model. And maybe the most encouraging statistic we shared on the call related to your question, a measure we use for guest satisfaction is intent to recommend. And our intent to recommend scores are actually back to where we were pre-pandemic, which tells us we're striking the right balance in terms of recovering the service levels we offered prior to the pandemic.
Hey, Tony, what's your visibility into China right now and how it's reopening?
So like many markets around the world, what we see is as borders start to open, as domestic travel starts to be more and more free, we see big spikes in search. We see more and more interest on both inbound and outbound travel. And as you know, China outbound travel is globally impactful, particularly impactful across the balance of Asia Pacific. So there's still lots to be worked through on visa wait times and the like. But the leading indicators on search activity are really encouraging for us. And China is our second biggest market. We mentioned in the earnings call that in the fourth quarter, cross-border travel globally was about 16% of total room nights. Great improvement quarter over quarter, but we still have some runway in front of us. In 2019, almost 20% of our global room nights were cross-border, so we think that presents some real upside in the next few quarters.
A positive macro trend there, but there is this trend that corporates, regardless of sector, have been dealing with are higher rates and the difficulty for getting financing because of the increased cost of capital. Tony, are there any projects, any big projects that you wanted to do but you just simply couldn't because financing is so difficult and so expensive right now?
So it's a bit of a good news, bad news. Some of the impediments to new unit growth, construction cost environment, interest rate environment, some of those availability of general contractors and subcontractors, the impact or the impediment of those factors is moderating. The availability of construction debt, especially for new construction, is the single biggest impediment we see today. We're still signing. We signed 108,000 new rooms last year. Where I think we have some measure of frustration is the pace at which shovels are getting in the ground, and the continued opening of the debt market should accelerate that pace of construction starts.
Hey, Tony, before we let you go, I'd just love to get a little bit more perspective on how you view the economy right now. You know, if job market on the one hand holds up, that could be good for your business, but everyone feels negative. So it's like things are okay in the data, but everyone feels really pessimistic or a little bit negative going forward. We saw that in the NFIB small business report today. Are you seeing that reflected at all? How do you then see the economy from your C-suite?
In so many ways, it's the most important question. We work in a cyclical business. Obviously, the travel and tourism sector is impacted by macroeconomic trends. We're just not seeing it in the data yet. If we look at how we've performed through the first 6 weeks of 2023, I mentioned earlier some of the forward booking data we're seeing into 23 and even 24. We are not seeing an impact on our business yet. The only caveat I will give you is what we call booking window. The period of time that elapses between you make your booking and you arrive at the hotel is only about 3 weeks today, which is meaningfully shorter than we experienced in a pre-pandemic world. So those trends could shift relatively quickly, but it's just not showing up in the data yet.
Tony, I'm afraid we're going to have to leave it there. Thank you so much, Marriott International CEO Tony Capuano, as shares move higher by about 1% today. This is Bloomberg. Sandro, a little over half an hour until these European markets close, really struggling to hang on to gains, not even up 0.1%. The equity index coming in after those CPI figures, but we did have some positive consumer earnings today, so that's helping lift the benchmark higher. Sterling, this is really struggling to find any direction either. It was first stronger after we got a blockbuster wage growth number coming from the UK, but the dollar has been dominating the story, the waffling after the CPI, but two-year yields, those surging in the UK. We have UK CPI tomorrow. That's trading at an October high. Coming up, we're going to be speaking with Maria Weitmana at State Street. This is Bloomberg.